How's it going, everyone? I'm here with August Biniaz, the Chief Investment Officer of CPI Capital, and we're at this incredible multifamily conference. You guys are essentially a very strong partner in this. Lots of insights today, and people are wondering very quickly, Paul, we just got a mortgage, want to rebuild wealth. My financial advisor said they should go into equity, stocks, mutual funds. You have something called alternatives, and it's related to real estate. Why don't you talk about that?
Absolutely. Conventional type of investments like equities, like bonds, stocks, they're totally fine. They're perfectly part of a well-diversified portfolio. But alternatives are also great. You're seeing, if you want to follow suit of what large institutions like university endowments, pension funds, what they're doing, they have a well-diversified portfolio, which allocation of it goes to the alternatives. Our space is alternatives, meaning that it's not a product that's available on a financial advisor's shelf. It's not a product that's available on the stock market. It's an alternative. You're actually investing in a team that buys, depending on what they're, in our case, we're in real estate, in a very niche kind of part of real estate, somewhat niche, because in the U.S. there's over 120 million people that live in apartment communities, so it's not really niche. But the investment kind of category is somewhat niche because it's alternative, meaning you invest in this with our firm, and we go and buy a property, and you're an owner or a limited partner within that, or fractional owner of that project.
A few terms which we'll get into, and usually there's a syndicate or a JV. Want to explain those really quickly and piggyback those on top of what you just talked about? So
absolutely,
in little words as possible, people can understand what that means at a high level, and of course we'll talk about what the investment opportunity is.
So basically, if you want to put a deal together, if you want to use a vehicle to put a deal together as an investment deal together, if it be it real estate or otherwise, there's just a few vehicles at your disposal. You can do a joint venture where you call up your buddy and you guys put your money together and buy something. That's called a JV or joint venture.
Right. We have to incorporate. Let's say you and me wanted to buy a property in Texas. A JV would be like we both incorporate.
That's right.
Have a hold co, and then we 50-50, and then we buy the assets under the JV.
And interestingly enough, the moment that you incorporate and you become 50-50 partners with whoever your partner is, you have automatically are now under the umbrella of the Securities Commission. You've triggered that already.
Which means what?
Which means that now you are overseen by the Securities Commission and you've got to abide by their rules and regulations.
That means extra fees and having to be careful in some way?
Not really. For example, in Canada, that falls under the private issuer exemption. So you're already exempt from having to do any kind of reporting to the being a reporting issuer for putting any reporting.
And so you're exempt. Why? Because it's for real estate or because it's a JV? Or
you're exempt from having to go through the conventional route of raising capital, which is the IPO route, initial public offering. So you don't have to go and do it at prospectus. All you have to do is you don't have to do anything. You've already triggered it. You fall under that umbrella of guidelines, which is less than 50 investors. You can only deal with family and friends or business associates or accredited investors. So now you created a company and now you're using this joint venture.
Got it. And then a syndicate, which is what you're talking.
A syndicate is basically you're now raising money from more people, like a big group of people.
Yeah, like if we want a JV and we don't have enough down payment, you want to go for a much bigger building. This is where you would you syndicate on top of the JV, or would we be like, no, let's just do a syndicate?
You would syndicate on top of a JV.
Yep.
Yeah. So now in this case, it will be a co-GP. So me and you are both general partners of the entity that's overseeing the deal, and our investors are the limited partners or the investors of the deal, who then are coming in as a syndicate. But this syndicate overall has a component of it, which is a JV. But it's also a syndicate that there's limited partners and general partners.
Right, and we're all under the same corporation here. So let's say we're 50-50 partners in the equity. People buy in, let's say $1 million building, right? We're 500,000. Then we got investors that come in and we're like, well, so let's say we want to buy the place in cash even. We instead of us putting in 500,000 each, we go 800,000 from the investors, 100, let's say, right? And then it's all under the same JV or corporation, or just very high level? How does that all relate?
Absolutely. So we would most probably create a limited partnership, which is an agreement between limited partners who are our investors who are funding that 800,000.
And they're all pooled together under a little vehicle.
Well, we're all jointly pooled together. It's all sitting within the same pool. We can even open a bank account for the limited partnership. So the funds all sit in that bank account. 800,000 of it comes from these limited partners who have subscribed to the limited partnership, whereas the money is sitting in our bank account. And 200,000 comes from me and you, who are general partners within the corporation that also sits within the limited partnership.
Got it.
So me and you are the owners of that corporation. Our limited partners are limited partners of this limited partnership. All of it is sitting within the same vehicle.
Got it.
Even though we own the corporation and we call the shots. So we make the decisions. And what happens?
LPs cannot make decisions.
LPs cannot. No, there is.
Even if they have majority, 80%, could they bound together?
No, they can't. But in the case of fraud, unscrupulous activities, they can get together and or death or some. If there's no succession plans, they can jump in and try to take over the partnership or the deal or what have you. And
Got it. So our viewers are probably going to be LPs to start. If they want to be GPs, hey, it's very possible. It's why we come to conference like this. And a good segue is a GP better know the local area they are investing into. So good case study now, you've got a place in Florida, right? Talk about why people are investing in the US, how you guys work, and how an LP can benefit versus, of course, a mutual fund.
Yeah, absolutely. I mean, just to answer the last question, mutual fund, I mean, our yields are much higher.
Yeah.
The returns we provide to investors are much higher. If a deal is
More usually.
I mean, if a deal is mutual funds, what is that, 6-7% in the best case scenario type of investment
management fees.
with a management fee that erodes a bit of that away. Or if a deal doesn't make around 20% average annualized returns, which is the cash flow and the back end profits combined, we're not going to be getting involved. We got to be making around 20% average annualized returns over the term of the project. So it's significantly more than your mutual fund type of investment.
Love it. So as you talk about this U.S. project, let's say one of our entrepreneurs or business owners or clients, they have let's say $100,000.
Sure. Easy math.
And then you're talking 20%. Talk about the cash flow and the profit part there, just so they understand how that's going to come back to them maybe 3 to 5 years. And just talk about the U.S. Why is the U.S. so hot?
Absolutely, yeah. As far as kind of their journey in this investment, is a $100,000 investment.
Yeah.
They're going to be receiving 7.6% average annualized cash flow.
Am I getting that monthly, quarterly?
You're getting it in this. It's kind of a deal by deal case. Usually we used to do monthly distributions. On this one, we're going to be doing quarterly distributions.
But it's a check in the mail, and or I can reinvest it to not get taxed.
That's usually in a fund structure where you reinvest it back into the fund again for better economics. But in our case, you get deposited into your bank account via EFT.
And do people get taxed on that usually? I assume they would.
So yeah, for the term of the project, we've noted this as return of capital.
Yeah.
So they're not going to be taxed for that period.
Interesting. Just the way you've labeled it, or how?
That's the way we basically labeled it.
Okay, yeah. So there's tax advantages. Talk to your accountant. Yep.
Talk about tax advantages, and then your next question was about U.S. investing. Why the U.S.? Frankly,
that's why the other part was that was the exit plan there. So I'm in 7.6%, quarterly.
Yes.
And then there's like most of the 20%. We've really counted for the 7%. I guess 13% would be off just the lift of the property. You guys are appreciating it and doing appreciation.
Combination of it, the natural market growth, the natural market appreciation that the property is going to have, the forced appreciation that we're going to be doing through our forced appreciation, meaning renovations and increasing rents, increasing the net operating income and reducing expenses.
Like any business.
Like any business. Exactly.
Profitability.
Exactly. And that's how we get to that 20%. But great question.
Good. And really quick, minimum investment usually, I know it depends per deal, but 100,000 was a nice round number. What's the minimum investment typically?
In our deal right now is 50,000. It's 50,000 USD.
Yep.
So we require investors to open up a USD bank account at their current institution in Canada and transfer the funds through that bank account.
And that's not bad. Some of them can be 25K, but that's probably far and few between. A lot of them are 100K minimum, right? So it's got to be a certain kind of investor.
Yeah.
And there's other models that can do this, but on a small scale. But this is one that's very specific. 20% is amazing. And then yes, so the big question, why the U.S. right now? And to maybe talk about your specific deal, just how you got the latest one and why not BC or Toronto or places that we're from. But
yes, well, my background is in real estate here locally in Vancouver.
Yep.
I cut my teeth on being a real estate agent, being a general contractor, building homes and doing larger townhouse projects. So I don't have a dog in the race. So my initial vision for CPI was to raise money to build ground up development projects here in Canada. But when I saw the yields that were available in the U.S. on a value-add deal, and when you differentiate a value-add and ground-up development, value-add is an existing asset, is already producing revenues. In the case, as tenants are stabilized, stabilized. So it made much more sense to raise money from investors to buy something that's cash flowing day one, rather than going to developing something where you're uncertain about what's going to happen in the future or where the rates are going to be. Is your performance still going to be there? Construction costs.
You're not getting cash flow while you're building this from day one.
Exactly.
Right?
Exactly.
Good. So it's quicker cash flow. You're less creativity, and maybe there's some limitation perhaps on a master plan from the ground up. Anyways, pros and cons. You're not for us, which is the importance of focus. So you're going to the U.S. You found this one right now in Florida. For example, you bought it for how much? High level.
This one here we bought it for 16.85 million.
So it's 60?
16,850,000, which works out to be 123,000 a door.
Yep.
So relatively speaking, I'll give you a good simple math, and your audience can do the math. If we bought it at $123,000 a door, our average in-place rents are at $1,375.
Yeah.
So it breaks the 1% rule. There is a rule in the US that use, which means that your 1 month's rent has to equal to 1% of your property's value.
Yeah.
If it breaks that or is around that, that's a great deal. In our case, it's above that. Now, if you do that to a condo in Vancouver or a condo in downtown Toronto, your $1 million condo might get you $3,000 a month.
Yeah.
Maybe a little more, maybe $4,000 if it's a really nice condo.
Right.
You're at 0.4 of a percent rather than being at that, in our case, above that 1% rule. So rent to value ratios is also more sophisticated viewers is the cap rates. The cap rates in the U.S. are higher than where they are at here in Canada.
It's, in other words, profitability, right?
Exactly. Cash on cash. Your cash on cash is higher in the U.S.
Yeah, and one of the speakers talked about how U.S. is at least 20% less expensive than Canada. You've got that. I mean, you're in a red state too, and the places you invested in, they're more landlord friendly.
That's right.
And it reduces certain headaches. But overall, it sounds like the numbers make sense, and so you're above that 1% threshold. And then back to the investors, they're like, this checks the boxes. So if you had the same project in Canada, I'm guessing it would be half, maybe. What are the typical syndicates in Canada, like the good ones, for example? If you're looking at, okay, this is 20% US, I'm going to make an LLC. There's a bit of work, but I'll look into it. What's looking
12%? 12%. Yep. So there's a group here that have advertising, and they proudly advertise 10 to 12%. So you can see there's almost double here what we offer. I know, but there's also pain points. A lot of times investors already deal with the CRA. They don't want to go and deal with the IRS as well. So the tax structure we put in place alleviates investors from having to file U.S. taxes, from having to deal with the IRS, from having to, any of these, or double taxation. Any of these other
because there is a tax treaty, correct? Is there an automatic one where, like,
as long as the structure you're utilizing is the right structure. Right. So, for example,
LLC, no, or
no, LLCs are not efficient at all. We don't have LLCs. In Canada.
Okay, interesting.
We either have.
If you're in the U.S., right?
Yeah. So in the U.S., so if you structure your deal in an LLC in the U.S. and bring on investors, that entity is not the right structure, and what will cause is you'll have to pay your taxes on the U.S. side, withholding taxes, and CRA will not recognize the LLC as a pass-through entity, which then they will tax you as well, saying that, hey, you can lose up to 70% of your taxes. And we've seen this with many investors who've invested with US-based groups who didn't understand the cross-border stuff.
Right.
And they're like, hey, just create an entity in the US, invest through that entity in our LLC, and everything, Bob's your uncle. And they've done that, and they've been double taxed.
That's the case. So you've got a better way to do that, hopefully less complicated even. Though I'm sure people will, of course, have to get in touch.
It is pretty complicated, yeah.
Fair enough, but I mean, you've simplified. That's kind of your job. Any parting words for people who have now learned about equities versus alternatives? They've learned about JVs, syndicates, GPLP. We covered a lot actually. It was awesome. And then why the U.S. Of course. Any last words?
Last word is the fact that you've made it to the end of this video for our friend Paul to ask this last question just is testament of your financial literacy. And that's my point: is educating yourself, going out there and understanding there's even options. Before getting into the real estate private equity space, I thought I knew everything about real estate. I thought I knew everything about investing, but more and more I learned that how much I didn't know and how much I didn't understand financial literacy. And at the foundation of generational wealth is something that we all try to achieve for ourselves, our kids, is financial literacy. And we win the prize for watching the video to the end. So keep pursuing different options that exist and different ways that you can, fight inflation. And real estate has always beat inflation. So if you can invest in real estate in a passive way, that's probably one of the greatest ways of building wealth.
Well said.
Thank you
so much, man. Long time coming.
Absolutely.
Thanks for sitting down and standing up with us today, man. I appreciate it.
Pleasure.
Awesome.